Thanks, everybody. Thanks for sticking around to the end to hear about tokenization. We're really excited for this panel. I'd like to go down the line here and have everybody introduce themselves and tell us what you do in your day job.
Sure. Hi, I'm Rob Krugman. I'm the Chief Digital Officer of Broadridge Financial, responsible for innovation.
Hi, everybody. I'm Emily Pollack. I'm head of corporate relations and investor relations at Republic. For those of you not familiar with Republic, we are a private investment platform focused on digitizing private securities.
Hey folks, Joe Medioli. I head up the financial institutions group at Anchorage Digital, which is our line of business covering asset managers, wealth managers, large banks, and our settlement network and counterparty risk mitigation infrastructure.
Hey everyone, my name is Ben Sharon. I'm the CEO and founder of LumiShare. We are doing tokenization of real world assets, specifically renewable energy projects.
Great, thanks. So let's start with the easy stuff. And I don't know who wants to take this first, but BUIDL has been a huge success, right? So what is it about that has enabled it to be such a huge success? And does it portend for the future?
I can jump in there. BUIDL's been a really interesting story and something we've followed closely at Anchorage. When you sort of think about when it launched back in March 24, right, it kind of came on the heels of the ETF launches. So there was a lot of market excitement about what I would call the legitimization of digital assets in the public space. And so what BUIDL did, and I think really paved the way for, with a number of other firms doing it since, is bringing in into the blockchain space a very common and well-known and understood product, right, the money market fund. I think what we've seen in the subsequent year and a half has been more investment in that space, more adoption, but also, interestingly, really bolstered by the growth in the stablecoin space. So we have the Genius Bill passed earlier this year. A lot of those are using the short-term treasury bills that are actually compliant as part of things like BUIDL and some of these other funds. So crypto is really doing a good job as an industry of sort of feeding itself to grow this space. But to me, it comes down to that sort of first launch in Q1 of 24 around the ETFs, and then the subsequent, we'll call it opening of the supervisory market.
I'll just add, I think that you mentioned the Genius Act, and I think one of the real drivers here is that the Genius Act explicitly says that stablecoins cannot return yield. So people want to put their money somewhere. So next step is money markets. I think that's why we're seeing tokenized equities much sooner than anyone could possibly ever expect it, because once you have digital cash, what are you going to do with it? You're going to want to invest it. And so you're going to see, you're seeing tokenized funds, you're seeing tokenized equities, tokenized privates and alts, because people want to place the money somewhere, especially as payments move on chain.
Yeah, I want to put a pin in that equity conversation for the moment. But Emily, anything from you on this topic?
I completely agree with them.
Okay, great. So one of the things that we talked about out there before we got started, Joe and I were talking, and I said, the analogy that I always give is it's the late 90s. We're all sitting around talking about this thing called the internet and what it's going to do for a bunch of different things, including e-commerce, or what will become e-commerce. We could all imagine a day when we would push a button and the dog food would show up. But it took us 20 plus years to get there. So I know, Joe, you have some thoughts as that analogy relates to tokenization.
Yeah, absolutely. I mean, very much in the early stages, among my own team, we have a running joke now. I've been with Anchorage for almost 4 years, and we said, tokenized securities are going to take off in, 8 to 12 months. And we've been saying that every 8 to 12 months for the last 4 years. I think we're getting closer. So I want to, I remain excited about this space. But, for me, especially in our position as a custodian, right, we see this world from an infrastructure perspective. The actual act, the technical act of tokenizing something is relatively easy. Providing custody for that token is generally straightforward as well, right? There's, obviously components that we need to think through around exclusive control. For us, it's everything that happens after that, right? From an issuance perspective, what kind of asset is, what is the supervisory regime around it? If it's a security, is there a secondary market, clearing obligations? So you start to peel back the onion, and there's an enormous amount of interest and infrastructure that needs to be built up to make it, to really like realize the efficiency promise of tokenized assets. The example I always give is I'll know that we've really made it in a blockchain world when the next time I buy a house. I live in Boston. If I don't have to go down to the Norfolk County Registry of Deeds and pay a lawyer in the basement $4,500 to do a lien search, like, we're there. But I also know that it's good. That's probably one of the last pieces to fall. Well said.
And I'd just add to that as well. I think at Republic, we've always been focused on being the Amazon of private markets. And there's a huge opportunity, especially in getting access to retail consumers and getting retail consumers in the investments that institutions are a part of every day. And so one of the ways that we've been doing that is focusing on cultural assets. So things like tokenizing the ownership of a sports club or film financing or a Hamilton Lane fund, which many institutions are aware of what Hamilton Lane is, but we found a lot of consumers weren't. And it's a great opportunity for your average person to get involved. And for institutions, it's a great way to distribute their products and get access to new capital.
Yeah, I'll add that, there's one of the ways that we look. So Broadridge sits in the middle of the financial ecosystem. We work with just about every broker dealer, every asset manager, every corporate issuer on earth. And, you can start to see when trends become real based upon the number of conversations that we have. And so if I go back even 6 months ago, the number of conversations we were having about digital assets infrastructure was probably once a week. And we have a repo platform that's gotten a lot of press. We're doing about 9 trillion a month in tokenized repo, very institutional driven. What's happened since? Well, we had the Genius Act pass. And I would say that that's a big milestone, I think, for this industry. Is the first time we have some form of regulatory rule making in the US market. And now if we're having 10 conversations a week with traditional banks and traditional broker dealers and others, that might be a low number. So the interest is here because I think people are starting to recognize that this technology is real, that crypto is not some kind of fad. It's not an illicit scheme. It's that these underlying cryptocurrencies are the basis. They're the Amazon Web Services, if you will, for financial services. And people are really excited about it.
So just let's widen the aperture a little bit here. So Ben, all this talk about infrastructure as it relates to financial assets, yours is a somewhat different use case. So maybe you want to talk a little bit about that and how these trends are affecting your business.
So I truly believe that the ETFs changed the game. We saw BlackRock, we saw all the big players start to adopt the RWA tokenization in general and to invest billions of dollars into it, and even predicted that it's going to be a $30 trillion market in the next few years. So I believe that transparency, including the due diligence part to mitigate the risk, and also liquidity, of course, are major keys in target to make it happen, to drive it into mass adoption. So along with, I said before, transparency. So I believe that as much as projects will use data-driven methodologies, I believe that it will help to attract investors. I'm not talking only about the big players, the institutions, but also the retail investors.
So maybe just give us just a minute or so on the difference in the regulatory environment where you operate versus what you're seeing here in the United States.
I think that from the regulatory perspective, I think it's quite the same, meaning that it's a broker-dealer license that needed to be done. And also, in our case, ATS license, because we are going to add a secondary market, especially in the renewable energy industry. Right now, if you are an investor and you are investing into this market, so you are locked up for between 15 to 25 years with this investment. So the secondary market is a game changer. Once you allow the investors to liquidate their investment, let's say within 6 to 12 months after they invested, so it will definitely attract more investors to get into this market. And on the same time, we saw that the growing demand for energy because of the data centers, the AI, the electric vehicles. So it's totally needed. And I believe that it's the best time to implement what we are doing in LumiShare right now.
Great. So one of the things that we wanted to come back to is the tokenization of equities, right? So far, most of the use cases we've seen have been in very opaque things like private credit, stuff like that. So let's talk about Galaxy. They just issued their equity as a token. So thoughts, good, bad, indifferent?
So I think you can look at Galaxy. What we've starting to see is there's three different models of tokenization that are beginning to kind of come of age in the equity space. The first is what Robinhood and Kraken and others are doing, where they're tokenizing at the broker-dealer level. So if you want to have, it really initially as a way of opening up U.S. markets to emerging markets where they may not have been able to easily participate in the U.S. I believe it's an interim solution. I don't know if others agree, but the next step is you start hearing NASDAQ and the DTCC talking about tokenization at that level. And what Galaxy did, which is, in my view, is probably the long-term game here, is you're going to see tokenization at the issuer level, right? So that public company issuers, private companies, mutual funds, other types of asset classes will tokenize through a transfer agent or some form. And then they're going to be able to take advantage of really global liquidity. And so the example I often give, Broadridge, we're a $30 billion public company. We trade in the New York Stock Exchange. And through that, if I could guess, we probably have access to about 250 million investors, those who direct invest through equities and those who buy mutual funds. Imagine tomorrow if we were actually listed on the top 100 exchanges all at the same time globally. We would have access to 3.5 billion people. Liquidity would increase. And you're talking about the most liquid market in the world, the United States. But you'd add additional liquidity. You would provide efficiencies and cost reductions. And frankly, by giving someone a tokenized asset, they can tie into DeFi, which actually provides them an opportunity to generate additional yield. And at the end of the day, returns is what drives the investment markets. And if you can actually have broker A, I get an 8% return, broker B, I get a 9% return, where are you going to put your money?
Yeah, and stable coins are the gateway drug, right?
They really are. Yeah.
Another advantage of, I think, the Galaxy of them tokenizing their Class A shares is just that there's now global distribution.
Absolutely.
There's 24/7 settlement, but there's also fragmented liquidity. And I think that's one of the disadvantages. And so one of the things we've been focused on is really building full stack infrastructure and figuring out how do you, at the issuance level, right, tokenize equity. We just announced something with Animoca, where we are working with that team, working with shareholders of Animoca to tokenize their equity on our 24/7 exchange. And so that's an interesting opportunity where Animoca actually announced their a reverse an RTO that they're moving towards with NASDAQ. And so even in the private markets, there's an opportunity for tokenization that leads up into into a company going public or in the public equities.
Yeah, I mean, the main thing I would add here is that, as I've sort of seen the space evolve myself over the last 4 or 5 years, one of the interesting nuances is when people go through these kind of like, at least previously, tokenization experiments and now increasingly like real investment, the big shift is in actually issuing on chain as opposed to just creating a tokenized representation of paper.
Well said.
And I think that's one of the big differences that we're actually starting to see here is people take the latter seriously, because the former is it's like the equivalent of you see a robot, but there's actually a person inside kind of moving it around. We're now actually making that transition. And I think that's where we really do have the potential. It's a lot harder to do it that way.
Yep.
But without that, it's really just a series of experiments.
Sure.
Yeah. So, Emily, we talked about this on the prep call. Want to kind of widen the aperture a little bit here in terms of which assets are seeing the most traction and why. And then are there any assets where it doesn't make sense to tokenize right now, where people are coming to you saying, oh, we want to tokenize, and you look at them and go, no, thanks.
We're seeing opportunity, and we focus on largely private markets across all asset types. So that's, as I kind of mentioned, sports clubs, film, that really resonates with your average retail investor, especially someone not familiar with investing in private equity, as most of your traditional retail investors that haven't had the opportunity to participate and don't even know what it is. And so we do see a lot of traction as it relates to these opportunities where it resonates. They're either a customer of a company or they're a fan of a certain producer. But then we're also seeing traction on the fund side. I think there's a big opportunity to get in front of retail and better educate investors what these opportunities are and better diversify the opportunity for capital. But we're not seeing too many areas where it's not applicable. I think if we're ever recommending not to move forward with tokenization, it's just if the team that we're working with doesn't have the bandwidth to put the effort in, right? Because there is a lot of legal groundwork, getting, for example, a legal team of a large institution comfortable with tokenization, there's a lot of work that has to go into it. And so from a leadership perspective, there needs to be a prioritization of this and understanding the benefits that it could add, but investing in that innovation.
Rob, sound like you had something to say on this?
Yeah, I mean, I agree. I think the other aspect is that I think if you asked all of us 6 months ago which class we wouldn't expect to be tokenized, it probably would be equities, right? Because they work pretty well, and that's already happening. I do think that there's a few things that have happened over the last few months. The signing of the executive order, specifically in the US around retirement plans, is really an interesting opportunity for tokenization. So defined contribution plans, retirement plans can now invest in private and alternative investments as well as crypto. How are you going to do that, right? So one approach is ETFs, right? And I think that's where the market initially thought. The other approach is now you have products that are available on Emily's platform, for example, that could actually be directly serviced into a retail investor through their retirement plan. That's pretty exciting. And so if you start to talk to the folks that run these defined contribution plans, they're thinking about new products and services that can go on top of their platforms. From a cap table management perspective, if you're a private alternative fund, tokenization is a much easier approach towards that. Because the opposite is you're going to have this crazy Excel table, right? So instead, the Excel table becomes a chain, and you can figure out who owns, and you can handle all of the governance and disclosure work right on top.
One thing I would add to what both of you said is, when we, again, like we're at a little bit of a different end of the market here. So a lot of the time we're having these conversations where folks come to us saying, hey, I have this tokenization project. Over the years, we sort of learned to ask in a very friendly way, why? Right? Because I think that's, I think you're right. Like you can, and you really can see efficiency in tokenizing just about everything. But it really comes down to the team, which is like, what is the value add around this? What's the monetization path? Have you thought through these different steps? Because otherwise, you're really actually adding quite a lot of cost unless you've really thought through that stack. So one of the things I would add to this is it really, the benefit here, I find, comes down to the type of firm that is coming to us and having this conversation. Why are you tokenizing? Maybe it's because you're trying to increase velocity to free up balance sheet to do more loan originations. This has been a really interesting one for you. Actually see a very clear path and use case. There's still a lot of work to be done, but that's a very meaningful and discrete way to add value to something. Whereas we were talking about this earlier, a couple of years ago, a lot of discussion around tokenized carbon credits. It's a really interesting idea. But when push came to shove, it was really hard to get off the line because one, the demand was a little bit unclear, and two, that downstream infrastructure of what are we actually putting on chain? Why are we putting it on chain? Seems like we're spending a lot of money to put it on chain, and we're not even quite sure where this industry is going to go. And so I think we do, as an industry, need to be careful about which projects we sort of put our effort behind, because we don't want to have too many of these experiments fizzle out. It sort of creates bad vibes.
Yeah, which is a great segue into what Ben is doing with your product, right? So talk to us a little bit about that journey of trying to democratize these long-term, long-tail assets and then create the alternative trading service that will help to unlock the liquidity.
Yeah. So right now it's limited. The renewable energy investments are limited only for big banks and institutional investors, and not all of them, by the way. So we would like to democratize it and to open this market not only for the big guys, but also for individual investors that will have the ability to invest starting of $500 per investment. And everything will be in fully transparent manner because we have our app that will be installed on the solar farm computers, for example, and will capture the data in real time, including how much electricity produced, the ESG, the carbon emissions, etc., and will make it accessible for everyone. So they will have the ability to make better decisions based on real-time data and not only about based on speculation, So I believe that, as I said before, it's the best time to implement that because of the need and the urgent need for electricity as we saw it right now.
Yeah, in my early days in the space, I was at Accenture at the time, a lot of large financial institutions were asking about this thing, blockchain and Bitcoin, that was going to kill them. And my response to them at the time was, it's not going to kill you unless you let it, unless you don't pay attention. What it is going to do is it's going to change some of the things that you do and how you do them, just as the internet did. So to that point, are you seeing in your world, Ben, the larger financial institutions starting to look at solutions like yours? Because let's face it, if the demand goes your way, the incumbents have no other choice but to get involved.
Yeah, I agree that first of all, the main investors will be and main liquidity will come from the institutions. So I spoke with a few institutions, most of them from the US, that focusing on clean energy, ESG, etc. So I believe that we are. It's not only me, but also from their feedback, we are going to make a shortcut for them because of the due diligence is taking them between 1 to 2 years for each of the projects. So because of our AI tool and the due diligence we are doing manually, so we are going, for example, I spoke with a firm that manage about $5 billion. So they are right now have the ability to invest only between 2 to 3 projects a year. So with our solution, they will have the ability to invest, for example, at the beginning in 6, 7 projects. So we are letting them the opportunity to increase their investments and to have a better and more efficient procedure.
Gotcha. So during the prep call, Joe, you mentioned that there are some unseen side benefits to tokenization. Do you want to expand on that a little bit?
Some what?
Some unseen side benefits to tokenization.
Yeah, I mean, one of the interesting areas, as we were talking about before, particularly for, I would say, I mean, what I would think of as now sort of esoteric in the digital asset space is the transparency that can come with opening up certain markets or asset classes. I think folks who were here yesterday, were talking about things like tokenizing rare earth metals, uranium, things like lithium, cobalt. These are areas where the benefit of tokenization initially may not be, we'll call it like greater liquidity out of the gate, but it's actually creating transparency into what is an otherwise gray market. And creating transparency attracts more institutional investors, attracts sovereigns, it creates better trade partners, may act as a better hedge to, we'll call it like global powers that are vying for certain access. And so I think there are some of these, I don't want to call them ancillary benefits because they're pretty core to what blockchain is and from like an ethos perspective. But one that tends to get lost, I think, when we focus a lot on things like equities as a starting point. The other thing I will add, and this is something that DTCC and Euroclear and others talk a lot about, we do quite a lot of as a firm on the, it's funny to say this, traditional digital asset side around things like BTC and ETH and those assets is collateral movement, right? The ability to leverage tokenized assets or even traditional crypto as eligible collateral for any number of transactions, be they derivatives or straight loans, also applies to the RWA space. If you can evidence the control over that asset, you can put collateral management ecosystem around it, you can attract lenders. And so I think there's also an element here about opening up utility, especially for investments that may have a long tail, right? If you're not able to cash out on something for 10 years, be great if you could take a line of credit out on it, or for the early BTC holders, the reason they do this is because they don't want the capital gains hit. Makes perfect sense.
Go ahead.
I would just say I completely agree. I think we're just cracking the surface as it relates to the benefits we're seeing of tokenization in blockchain. And on the utility side, I think from an institutional perspective, you might not even think about how you can engage consumers or retail investors or even institutional investors through utility of tokenization. So for example, we've done a lot, as I mentioned, with the sports clubs where investors, if you're above a certain level of investment, you might unlock certain benefits. And that could be walking through an owner's entrance of a stadium or, having special perks. And so there's a lot to do outside of just thinking about the financial benefits. And, there's a lot of engagement and from a marketing perspective, things that people don't even think about.
I would admit those are even more fun perks than I.
Yeah, and if anybody wants to do a little homework on that, the best example, even though it's old now, it's 7 years, hard to believe, is the tokenization of the St. Regis Hotel in Aspen, right? So they raised 18% of the ownership, I think. It was almost $20 million, but in addition to the ownership, you got benefits for stays at the hotel. So that was kind of interesting. So let's talk about that harmonization piece. Does TradFi just run this whole thing over and eat it, or do you see more of an integration of what you're doing with the traditional finance players?
I don't think the DeFi community is going away. I do think some of the TradFi players will, in particular on the intermediary side. I think that what we're seeing now, if you think about why this has taken a while, we had the blow up that happened about 4 or 5 years ago with FTX, and that freaked everyone out. But at that time, they always say, like, in winter is when work starts, right? Work started, right? JP Morgan started, Credit Suisse, all different types of banks around the world started to look at this. We launched a repo platform 6 years ago that we were doing nothing on it. Now, I think this morning we announced we're doing $384 billion a day. So it's the comfort level, number one. Number two is regulatory clarity, which is starting to come out. And I think once regulatory clarity comes out, I think people start to build on top of it. And the third one, which is probably the most important, is how do I make money? And I think it took folks a little while. And listen, if you run a traditional business and all of a sudden you see this new thing and you're like, well, wait a second, I make $100 billion over here, $5 billion over here. You're telling me that's going to go away? The initial reaction is, I'm going to fight that a little bit. I think we're on the other side of that now. But just look at the acquisitions over the last few weeks, last few months. Traditional financial services companies are starting to gobble up some of the DeFi organizations, but that's not going to gobble them up. Look what Coinbase is doing, right? They seem to be playing in every single space here. So I think you're going to see the establishment of new organizations and new powerhouses in the space, not too different in my head from the late 90s, where we started to see trading go online. And when trading went online, you have a few companies that have continued through the test of time and introduced new ways. We saw price of trades go from $150 to $10 now to free. That was all front office. We're going to start to see the same thing on the back office, which is what this is.
Yeah, I think, adding to that, I think the other side is happening too, which is we have the crypto native players that are working their way into TradFi space from a full stack perspective, right? You mentioned Coinbase playing in this space. We obviously took a pretty, was a unique path at the time, and now seems like, de rigueur is going down the path of getting a federal bank charter in 21. There's 10, 12 of those pending right now, many of those crypto native firms. And so I think we're seeing this merger, I suppose, within the ecosystem. I do think the regulatory clarity piece is a really interesting one. Genius, certainly a really momentous part of this year, but is really only a small part of the story. Like what we're pending on around market infrastructure is huge. And what's interesting about that from the TradFi question is, I see Genius as a bit of a wake-up call to a lot of the large traditional banks, particularly the GSIBs, regionals, super regionals, that were sort of waiting on the sidelines. Now they're playing a little bit of catch-up, and you can actually see that as you read through like the House version of market infrastructure. It's pretty, one-sided, let's put it that way, to a certain part of the industry. And so now I think the larger banks are kind of getting a little bit caught up. They're on the Hill. I run into these people on the Hill. But I think what's good about this is that folks are engaging in a way that they really want something sustainable. Will we get that? Is a big question. All of this legislation is going to actually eventually have to work its way down to rulemaking. That'll probably take another 2 years, and that's assuming we get something in market infrastructure within the next few months. I think we're on the right path. It's just going to take a lot of time. We need to make sure we don't go so far one direction that we end up with a pendulum swing in 3 years.
I think, though, that to your point, I think the Clarity Act really starts to answer the questions around risk. And that why are traditional financial services companies, they're terrified of risk, right? So if you start to answer some of those questions, it starts to level the playing field a little bit.
Absolutely. Yeah.
So let's talk about some of the boring stuff for a minute here. From an operational perspective, what are some of the challenges around things like auditability, data governance of the products, and smart contract risks?
I can start from a security perspective. That's obviously where we play in. When we look at any of these assets, we sort of always come back to the kernel, right? The security and the custody piece. And for us, that really means how do we ensure that we are fulfilling our duty as a custodian and basically guaranteeing that we have exclusive control over that asset and we are participating in the change of beneficial ownership. now it seems relatively easy to do that in the case of, say, something like Bitcoin. But when we start going into the smart contract space or staking space, it's a much more esoteric conversation. And that comes down to our ability as a firm to evidence that control over the private keys that are signing those transactions. And as a firm, if we're going to take that on or take on any sort of smart contract participation, we have to sort of look through to that secondary and tertiary question of, when is this staying within the confines of the custodian? If it's in the smart contract, as long as we retain that private key control, we're comfortable that it's in transit, but not necessarily out of custody until the both sides of that transaction have been satisfied. So we really have to do a lot of legal analysis on any one of these things to get comfortable. And that applies to things like staking as well.
Yeah, and I would argue, and we said this on the call, my joke always is smart contracts are neither smart nor contracts. It's automated business logic. There's a set of inputs that goes into this thing, and based on those inputs, there's an output. So what are the challenges and risks around the inputs? Because I don't need to attack the chain. I just need to attack the oracle or the input into that contract.
I think that's why I was at a conference yesterday at an office of one of the big four. And I think each of them are focused on actually doing smart contract auditing. You're not going to get a pen signature on the bottom of this like you would an audited financial report, but it's really to your point, it's basically a code analysis. It's looking at the code and highlighting challenges and issues that may exist and making sure that people are aware of those. There's going to be a new form of disclosure that's going to have to come out with this, that when you buy a product, particularly at the retail level, that people understand not just what they're buying, but what the actual role of the smart contract is, how it works, how it operates. And that's going to be all over the place. I think you mentioned mortgages earlier, right? Like if you think about the 175 pages of paper, which I think has been reduced from the 450 pages before 2008, that's going to all be codified. How do you actually explain that to an individual becomes really important. And so I think that's where common sense disclosure written in plain language is going to become a really important component of this stuff.
It's a really good point. And one thing I would add to that is when you think about that auditability, one of the interesting advantages of tokenization is that you have an issuer.
Yeah.
Right. Unlike, again, the word traditional crypto, you actually can kind of roll back stuff in tokenization if you really have to. We obviously don't want to do that.
Sure.
So, but that is in some respects, and I think an underappreciated benefit that folks haven't quite realized yet. Whereas when you're dealing in things like Bitcoin or Ethereum, you're really dealing with, bearer assets at that stage. And as a firm that grew up with that as our remit, the other side of this is the work you do to validate that initial intent on the investor side. So sure, we have the smart contract component of this, but are we comfortable as a firm that, this institution that's going to put, $1.5 billion into this smart contract really intends to do that?
Yep.
Right. Because of all of those downstream impacts.
Absolutely.
I will add that I believe in simplicity regarding the smart contracts. So as simple as you will create the smart contracts, you will avoid security issues, etc. And from the other end, it's super important to make audit on each of the smart contracts, not only one time, but to keep it live every few months, for example. And also, I will add that you have companies like 𝐓𝐡𝐞 and other companies that helping you to monitor and to create the audit on your smart contract, and also Chainlink, for example, that are doing online on-chain analysis and due diligence. And in our case, they are doing even ESG due diligence and analysis. So it's really helpful. And another thing that I will add, that AI tools today can help to translate the smart contracts for the simple people, to understand everything in simple terms, so they don't have any surprises or anything like that. And it will make their life easier, especially if we are talking about the retail investors.
And there's a tremendous amount of legal and technical engineering that has to happen in the background. And so it's so important as an investor or as an institution, as you're looking at tokenization, ensuring you're working with the right players, because the market is also very saturated and people, working to tokenize XYZ. And so making sure that, you are working with a player that is compliant and has that full team and capabilities.
I think to your point, I think that I was speaking to someone the other day and they asked me like, what's the biggest challenge that needs to be overcome? It's education, right? So I think all four of us are working in the space right now. And I think it's safe to say that there is stuff that you read every single day and you're like, huh? Right?
Yeah.
And you have to go back and read it again. That happens on a constant basis. Now, I find internally it's really important that we bring things down to simple terms so that we can explain them to folks. That's really what we're dealing with, right? It's even at the regulatory level and the elected official level, is you're going in and speaking to them about something, they have a certain mindset, and you're asking them to convert that mindset to work a little bit differently. And so starting at the basics versus trying to assume that they're PhDs becomes really important here. Yeah.
I totally agree with Rob, and I will add that regarding education, right now it's the best time to educate the crowd, and even the regulators, and even I'm talking about the institutions also, because it's like the days of the beginning of the internet, as I mentioned before. People don't really realize and understand how it's going to happen, how it's going to work. So we need to educate them. We need to give them the guidelines and everything so they have the ability to make it happen and to start the mass adoption.
Yeah, and let's hope the positive regulatory environment continues that allows us to work with regulators to create those frameworks instead of fighting with them. So we just have a couple more minutes here. I want to go down the line. Predictions. A year from now, we're up on this stage. What are we talking about?
A year from now. A year from now, I hope that Trump administration will keep their words and they will really make the US as the world, the tokenization capital, and they will achieve more and create more regulations and laws related to that, and invest more about the crypto and tokenization specifically. We saw that Eric Trump and his company, World Liberty Financial, say that they are going to tokenize real estate. So I believe it's helpful from the PR perspective from one end. And we saw that JP Morgan say that they are going to tokenize private equity soon using their company. So I hope and believe that in 1 year from today, we will be in the beginning of the mass adoption. At least, let's say, 20% of the institutions and some signals of retail investors that getting into the market and increasing the volume.
So Joe, you and I talked a little bit about this outside before. A year from now, is it Groundhog Day or have we moved forward?
It's a great question. I was going to say, here's my prediction and here's my hope. My prediction is that it won't be quite Groundhog Day, but we're going to be talking about like pending SEC rulemaking around secondary market trading and securities. My hope is that we're a little farther beyond that. I'm a really big believer in the sort of like what I would call broad swath of the wealth management space as being able to kind of really pioneer access to these markets. What I would love to see a year from now is an SMA that combines your traditional cryptos with tokenized fund elements, all within one ecosystem, not split across 4 different custodians and accounts with a data aggregation at like an add parlor. So that's my prediction, my hope. Yeah.
I would completely agree. But I'd also suggest that I think we're going to see a lot more assets come on chain. I think a lot more institutions are going to be participants where they may not be today. And I think we're going to see more participation from investors as well. So I think overall, we're going to see a lot of growth in the next year, but not quite maybe enough.
I'm gonna go out there a little bit.
Okay.
So I'm gonna say we're gonna see a solution for the identity problem that exists, because that's, if you ask me, I don't know if you guys agree, but I think the one thing that's holding the entire industry back, specifically in the retail market, is solving for consumer identity on chain. Because once that solves, then you can truly have decentralization. There are so many projects going on around this. I actually think this is where the traditional financial services industry can help, is that because they're not going to do things if they can't guarantee AML and KYC compliance. I don't think anyone else is either. So that's a bottleneck that needs to be passed. And I think that between now and a year from now, we're going to see at least standards starting to be aligned around that, probably in line with the Clarity Act, but the market can't move forward if we don't have identity.
Agreed. Well, I want to thank our panelists and everyone for your time and your attention, and hopefully we'll see you next year.
Thank you.